So, first and foremost, step one, full disclosure. Put every material fact about the relationship and the deal terms in front of the board or the relevant committee. Nothing half disclosed now helps you later. Second, recusal. Have the interested director step out of the deliberation and abstain from the vote. Even though the new statute under Delaware Section 144 is more forgiving of mere presence participation if disclosure was complete, our recommendation is just to recuse yourself. Third step, get a disinterested majority. So if a majority of your board is genuinely independent on the transaction, have them approve it. If your board is small and mostly insiders, so like common pre-Series A, you may not have enough disinterested directors to make this route available. And in your example, Lindsay, party A from number one would have to vote on party A's side for that transaction. And then the fourth step, you want to consider a stockholder vote instead or in addition to the board vote. So for early stage companies where the board is thin and informed, uncoerced disinterested stockholder approval is often the more reliable cleanse as is independently sufficient. Step number 5, you want to document all of this contemporaneously. So board minutes should recite what was disclosed, that the interested director accused himself, that the basis for the disinterested director's approval, whatever that may be, you want to make sure that's all documented. And the process is still what wins if a later dispute or acquires diligence team challenges the transaction. And then lastly, you want to still aim for fair terms. So even with a clean procedural cleanse, it's great practice and relevant if the safe harbor is ever challenged or doesn't fully apply to be able to show that the deal was actually on arm's length and on commercially reasonable terms. So what we advise most of our clients at MLG is that you really want to get an IP valuation by a CPA to set the market terms, to set the price for the IP for that IP portfolio changing hands.
Price can vary quite a bit, folks. At smaller firms versus bigger firms, that's one variable. Also, depending on how and whether the IP portfolio has been monetized or commercialized, that's also another variable that can make a difference. Our clients have paid anywhere from $10,000 to $60,000 for that IP valuation. So it is no small cost, but it is a great CYA to have in your back pocket as opposed to relying on your own number. Anyway, this is something that comes up often. It is something that we see quite debated as far as whether or not to even get that IP valuation in light of cost. But our general recommendation is to go ahead and call your CPA valuation expert, whoever he or she or they may be, and get that papered. It usually comes as an IP valuation report, and then we as the counsel will prepare a business asset purchase agreement and attach the report as an exhibit. So again, something to do, something to consider when you're going through this process.